right. Peace, power, and profit. Peace, power, and profit. Uncle Johnson Neb to the fam, to the traders, to entrepreneurs, to go-getters, those who are charting a path of excellence under their own merit. We want to recognize you all today. We appreciate everyone who comes through this channel and support it through a like, subscribe, or a view. Every now and then, the occasional cash outs. We appreciate that as well. Today is what they call D-Day, right? As somewhat affectionately title it. Today is D-Day in Normandy, right? We're gonna drop some bombs, right? The Fed's gonna drop some bombs today, some bombs, I should say, right? We have the official FOMC, Federal Open Market Committee meeting today, headed by the chair, Jerome Powell. He's going to come before you guys through the value of course, giving a guidance or a form of expectations of what they're planning to do going forward in dealing with inflation. Now, this is a normal meeting that happens every year around this time. They have them, throughout the year. Nothing special about that. But what makes this one here very special is the fact that there's so many things looming over, the economy as a whole. Right? I'm not going to say the market because most people tie Jerome Powell to the market, but just the economy as a whole, which their job description, outlines that, or I should say, it lays out the path that they're supposed to be a neutral organization that seeks to fill in the gaps of the American economy, somewhat in ways when it comes to the economic side of things, on job placements, natural disasters, anything of that nature where there's an emergency needed. The Fed is supposed to be there somewhat to backstop, the economy. What we've witnessed over the time since we've had the COVID crisis, where there was a need to, again, protect a lot of the, America's pension funds, savings, retirement, the whole nine. The Fed stepped in, mortgages. They stepped in and did some, some very, unusual feats. At the time, of course, it made sense for a lot of people because, again, no one had ever experienced this in our lifetime, and having to deal with a pandemic of this magnitude, whether it was necessary or not, that'll be the judge for someone to make that decision at some point in their life. But as of today, we look back and we say, okay, well, did we go overboard? Was it just enough, or was it not enough? Right? That's the question most people have to ask, or the questions that are posed, right? But for the most part, we can say that, okay, we witnessed, the Fed's balance sheets grow literally from now. At that time, I think the Fed's balance sheet was sitting at around about maybe $2 to $3 trillion, right? Maybe four at most, but about 2 or 3 trillion. Now it has ballooned up north of near $9 trillion. $9 trillion is sitting on the Federal Reserve assets, holding their books, their balance sheet. And the majority of that money is supposed to have gone into, number one, backstopping American people's, financial stress test, scenarios, home mortgage, jobs, the whole nine, right? Quality of life, food, economy, the whole nine. And I asked a question to a lot of people, as I always do. Do you guys really feel like your tax dollars, effectively worked for you by way of the Federal Reserve? And I'm saying that because this money is sitting on their balance sheets. This money is supposed to be helping you, helping America, helping small businesses, helping the average person to get through this pandemic, which is now becoming an endemic scenario. And from there, your quality of life is supposed to be somewhat padded, or feel like it's some semblance back to some form of normalcy, right? Even though we still haven't got back into our, natural order flow of things and business, 100%. But for not dealing with all this forward tax money itemization that came from you having to pay this into the future, right? Your kids going to have to pay this bill. Do you really feel like your life feels like it's protected, or was protected by way of the Federal Reserve printing all that money, right? A very serious question one has to ask him or herself when you think about what we're dealing with today, right? Which is the elephant in the room, right? Inflation, right? Inflation, a monetary phenomenon, right? What is that? Well, they said, as the late Milton Friedman would say, inflation is always spawned on the back of excessive money printing, right? Excessive money printing causes inflation. Why? Because you have too many dollars chasing too fewer goods. And if you don't have enough adequate labor to balance out that debt to equity ratio, then that breeds inflation. Why? Because people feel like at this point, okay, well, I have something that everybody wants. There's no need for me to really, manufacture a whole lot more than what I have, be that a necessity that they can or they can't. They can begin to now raise prices on those goods because it becomes a game of scarcity. With scarcity, in comes what? A flight to quality, a flight to necessity, so to speak. As opposed to quantity. Why? Because you have to protect those things that you can, that you need on a necessity level, and things that you typically want, surplus things, you go without those things. Why? Because again, the prices of these things goes up. Again, gas, energy, food, cars, clothing. I mean, whatever, right? This stuff is skyrocketing right now. And it's singly because of one thing and one thing only, the Federal Reserve. Of late, we've been watching, this current administration go on a campaign to convince people that it's not their fault. It's not the Federal Reserve fault. There's this massive propaganda campaign going around saying that, it's everybody else's fault except those people who've been put in place in power to be good money managers, to be good, executives. It's not their fault. It's everybody else's fault. It's supply chain issues because of COVID and China alone held back products from coming into America. It's the reason why America's job market hasn't returned to the point where people are flush with cash to spend money into the economy to circulate, to balance out that issue. Too, it's everybody else's fault except those who are in control of this vehicle called America. And we do know, again, for what it's worth, the head person in charge is the Federal Reserve. Why? Because they control the money. As they say, are you in charge of the girls, right? Y'all remember the movie Harlem Nights? Are you in charge of the girls? I am in charge of the girls. If you in charge of the girls, then handle it. Why? Because, the girls coming up short, right? They're coming up short. And a lot of Americans are feeling that in their wallets, their pocketbooks, their purses, their savings, their buying power, the strength of their dollars being diluted by way of the Federal Reserve taking taxpayers' money, future taxpayers' money, and dumping it into equity markets, literally into equity markets, and not your pocketbooks, your savings account, things of that nature. And I asked, did any of you guys sign up for that? Did any of you guys vote for that to happen in such a scenario that we've dealt with here since COVID? And now we have a bigger crisis because we have a ongoing worldly conflict in Russia and Ukraine that has also have world implications. Why? Because of what? Production, export, raw materials, commodities that are very, necessity, interest value when it comes to, the biggest wheat producers on the planet comes out of that region between Russia and Ukraine. All right. They have nickel, palladium, right? Fertilizer. Right. Again, we're talking about being able to grow crops. And even in America, Brazil, those subtropical regions where they grow a lot of crops to export around the world, they're suffering because they need certain things to allow that process to happen. And fertilizer, potash, right? Belarus, Ukraine, Russia, biggest fertilizer producers literally on the planet. Natural gas, petroleum, some of the biggest, exporters of natural gas or energy on the planet comes out of that region as well in terms of Russia. So all this power is connected and tied to Russia, yet you have American government a European Union, which in NATO, right? This European alliance, that's basically what they are. This the Voltron of European nations that came together to do a takeover in the European region, and they overstepped. They welcome a little bit more by pushing more into Russia, whether you hate, like, love it, indifferent to it. And because of that, Putin got a problem with it. Does not exonerate him for what he's doing and terrorizing people and what's going on in Ukraine. Doesn't negate the fact that he feel like that's a part of what their old homeland. He's just trying to eradicate the radicals that are in that area now because of what? A coup that was pulled in 2014 under the Obama administration, where they put in a puppet regime, eventually trying to what? Be closer to that of Putin to keep an eye on him, which obviously they, broke some treaties, some laws in doing so. And now the repercussions are now we're dealing with that on a global scale because everything is stopped in that region to deal with their what? Their civil dispute. Let that marinate. It's a civil dispute where now you're being also forced to do your American civic duty and pony up more tax dollars to support the Ukrainian army, the Ukrainian people. Again, did you vote for that though? To the tune of $14 billion of your money is now going to help Ukrainians when small businesses in America are crumbling and failing and dying and being lost. Roads are still raggedy, bridges are still crumbling, schools are still ratchet because they're not taking the typical level of care to protect our future through our children. Food is still all over the place. The cost of again, everything in this country is going through the roof. No one sees that as a problem that sits in these, congressional halls, and they act like this is normal, and they want you to bite the bullet every day while they play, in their mind, Superman and Superwoman with your tax dollars without your approval. This is the extent of what this country has become. Now, on top of that, again, adding to that of the fuel that the Fed spews and taking taxpayers' money, printing it, and giving it to equity markets. Again, not you and me, the average person, citizen. They're giving it to equity markets because they feel like that's the best way to protect the economy in that whole sham of what? A rising tide lift all boats, right? The tide is the money that you're pumping into this system through taxes that goes to equity markets, CEOs, companies who have well endowed more than they need, and they feel like that gives them the ability to hire people, and in doing so gives them somewhat of a better quality of life. But again, you're talking about inflation kicking everybody in the teeth to the tune where they hire you and not paying you substantially what you're needing to need or use to live in a high inflationary environment. Like what goes? Like, make that make sense. How is it a great trade-off just to be slaving for someone and slave wages for someone while they live their best life? The hustle of this country has been exposed more than people have ever thought. Who knew a pandemic would kick it off? Who knew now this Russia war scenario would make it even more of a window to see exactly what's happening in around our government? You've been sold a bill of goods. A lot of you guys knew this from the beginning. It's nothing new to most of you all. But for a lot of people, they're getting a wake-up call now. They're starting to realize that government has always been a sham. And that's why a lot of people fight for what? Less government. Less government. Why? Because too much control gives these people unwielding power to make decisions that ordinarily people would not go for given the opportunity. They're just taking your money and just giving it away to everybody except you. Illegal immigrants come across the border, there goes your tax dollars. Issues pop off overseas because, they tried to maybe invade somebody and they failed, which we did in Afghanistan, Iraq, Kosovo, Syria, Libya. The list is endless. We failed in all those theaters, and yet we're paying these people your money because they thought they can go in there and get the resources. Some of them they've been able to do, but for the most part, you're paying for that now. And now they're egging on, agitating, picking a fight with one of the biggest bears in this, global, realm, if you will, in Russia, poking that bear And these people, again, have nuclear capabilities. Why? Because they tried to overtake or overthrow that environment, so to speak, by putting a failed state in terms of Ukraine, whether you hate, like, loved it. That's just the historical context to it. And because of that, now we're all suffering at the pump, in the grocery store, again, energy bills, whatever, utilities. Again, it's a cycle that has become very insidious, that now they're depending on you, the average hardworking citizen in this country, to foot the bill for everybody, everybody except yourselves. Everybody outside these coastlines except yourselves. Everybody outside these coastlines except you. And they sell a good wolf game every day to get people to fall for it. Their propaganda machine is so strong. They're censoring truth. They're censoring, you know, people who are intelligent, that can make logical decisions and map things and put things together. They're censoring you because you got questions. More important to what they're doing with your money. So here we are today, where you have this, as you see on my screen here. I like to try to provide a little context and color per my thumbnails. I know they're fun in their own way. Here you have the drama queen of the century in Jerome Powell, a spawn of, Ben Bernanke, Alex Greenspan, and Janet Yellen all in one, right? Who have yet to take the responsibility and fix the mess that he has also caused, exacerbated by the current administration, exacerbated by the scenario that's also going on with Russia, but Russia did not cause inflation. Russia did not cause inflation. I repeat, Russia-Ukraine situation did not cause inflation. There's a lot going around right now where the administration got on a conference call with the top TikTok producers on the planet, content creators, and fed them a propaganda script to go on their channels and tell everybody that listens to them that it's because of Russia that we have inflation. Even a 3-year-old knows it's a lie. They want you guys to go for this foolishness to the extent, again, that it's not even funny at this point. Again, it's this whole reality. It's this reality. It went from being transitory. Oh, nah, it's good. Oh, corporate greed is causing it. Oh, it's Putin's fault. Like, they're literally peeing on you guys and telling you that it's what? A lemonade shower. The heavens just open up and drop you guys unlimited, country time lemonade, right? Some of you guys know what country time lemonade. This is the extent of what we're dealing with here. This is the extent of what we're dealing with here. And on a day like today, where you can unequivocally, again, just think about it, guys. Today is the day, is like the Super Bowl of the stock market. Today is like the NBA championship of the stock market, the NHL hockey tournament championship, the NLB. It's the World Cup of the stock market today. Why? Because this is the day that the Federal Reserve is dreading. Why? Because they've been so inebriated and zombified by the value of having all this power to print fake money out of thin air and give it to stock market, participants, in terms of these companies, for the most part, at low interest rate environment, so they could turn around and buy real tangible assets with monopoly money. And because of that, they want to keep that party going as long as they can. Why? Because the wealthy are loving it. They're feeding off taxpayers' money and doing nothing in terms of giving back to the people that has now foot that bill to bail these jokers out, because they were fiduciary irresponsible with their business practices. They didn't have money put away like they tell you to you need to have 6 months of what, 6 months worth of income put away for a rainy day. These are $1 billion, $1 trillion corporations. They're not under that same parameters you telling me. So anytime we have bad news, a bad scenario, bad whatever incident, they're not responsible to do those things as well. Again, this is the extent of what we're dealing with here, guys. So today, the magnification of this day is very important for those reasons and those reasons alone. And so being able to outline that before we get into these, this so-called phenomenon of watching the Feds, deliver, the usual, talking points of, well, because of this, now we have to, possibly pivot and not go as hard as we wanted to. Again, the excuses are endless in terms of what they've been able to, uh, continuously doing, kicking the can down the road, and and taking more and more money out of the taxpayers' ability, to put that money to work rightfully so, or to use it to benefit their scenario through, equipping these again work environments in a more better, suitable safety environment. They cut the COVID bill out. They cut the COVID relief money out of this bill that Joe Biden just literally signed and gave that money to Ukraine. So now you got to navigate whether you have an issue with COVID or you don't, whatever the case. They took that portion of the money out and are now giving it to Ukraine. Couldn't make this stuff up, guys. Couldn't make this stuff up. And again, I'm just asking for a friend. Did you sign off on that? Did any of you guys sign off on that? Did they even give you a chance to whether you would agree to that or did not agree? I don't know if you guys even saw, they had a teleconference this morning where the president of Ukraine, Zelensky, and his comptroller, whomever, right, if you will, got on live and kind of made this declaration or plea to America to do more, send more money to help them deal with with Russia. And these people, these, again, politicians, whatever you want to call it, politics, they're moved on emotion. But why? Because they have vested interests in those regions. We found out by doing proper research that there's a connection with the Biden administration, with the Nancy Pelosi's, with the John Kerry's, right, with the Mitt Romney's, where they have children or relatives in Ukraine, heading positions, getting paid on the payroll to keep this, again, regime in place. This failed coup, that's what it is. Whether you have a problem with it or not, that's not my fault, my problem. It is a failed coup that was administered under the Biden administration, the Obama administration, right? So here we go. We're dealing with, again, more of the same, where not only are they taking your money and giving it to anybody, that does not have a vested interest in this country, but they're also taking your money by the way of the Federal Reserve and giving it to the stock market equity holders so they can turn around and censor, free speech, free opportunities for everybody else to have the same playing field. They're narrowing the field of scope for other people to come in and be able to benefit from it. Why? Because they're trying to play the role of, I don't know, they're trying to play the role of Thanos. They're literally, the government is trying to play the role of Thanos, and they got all these corporations who are just on board, just willing to go above and beyond to play this game as well. And they're doing it again at the expense of you, the taxpayer. So I don't know. But again, a lot to discuss today. We're going to talk about it again. I'm not going to be here super long. I got about a couple hours because I have a session coming up at 3 p.m. But again, I have to lay this groundwork, whether you guys, I'm sure you guys have your own, take on this, and that's fine. And we all have our differences of thought when it comes to this stuff. But one thing we do know for sure, that no one is winning here in America. No one is winning right now in America. On a universal level. Why? Because again, they're taking advantage of your situation. They're pulling on your heartstrings to make you fall for this stuff. They're getting you to just accept any and everything that they're pushing. And it's like, what do you do? How do you push back? I mean, again, midterms coming up. That's going to really, really detail a lot of things that a lot of people have been waiting to kind of just pressure release. And I will say this, and I'm not, I don't play the political party game. I don't do the Democrat, Republican thuggling thing. I don't do none of that. But I can assure you, it's going to be a big shockwave that's going to happen at this next midterm election. This midterm election is going to be like crazy. It's going to be crazy, right? So, again, whatever, right? But anyway, so let's get to it, guys. So let's get to it. We know what's coming. We know that they're, ready to drop this news on false interest rates, and we're gonna get right to it, guys. So let's do this.
Today's pretty straightforward. I think the risks are they're hawkish today. Inflation's high and job growth has been good. But I want to pick up on something Mona said. I think it gets much harder from here. I think the downward revision to growth is a sign of things to come. The growth risks are to the downside. I think the uncertainty in Ukraine probably adds to those. And so while it's pretty straightforward to hike rates today when job growth is okay, inflation's high, it's going to get a lot trickier when growth risks start to emerge on the downside. And so I think straightforward today, but harder in coming meetings, and harder in particular because the growth is likely to decelerate. Risks are that it decelerates more as we move into the end of the year.
But curiously enough, David Kelly, the argument Larry Summers was making in the Washington Post last night is that he's sort of blaming the Fed for that slowdown. We all say, the macro slowdown happened to the Fed. And he's saying, no, it's because they're letting policy run too hot that we're going to risk recession and stagflation.
No, I don't really agree with that. I think that the other side of Washington has kind of set this up by putting massive stimulus into the economy during the pandemic, both to protect people who are affected by the pandemic, but also to protect people who weren't being affected by the pandemic. That gave you excess demand, meeting insufficient supply. That's why we got all this inflation here, and that's why we're coming in too hot towards full employment. But the Federal Reserve can't fix all of this. I think the Federal Reserve needs to be steady here. I agree with John that there is a danger that the economy is going to slow in 2023, and what the Fed doesn't want to do is overdo it and have to change course. I'd rather the Fed take it slowly here and have multiple years in which they try to get rates and their balance sheet back to normal, rather than precipitating a crisis.
Dow's up 242. Let's get to Steve Leisman with the Fed decision. Steve?
Federal Reserve raising interest rates to a new range of 0.25 to 0.5%, up a quarter on the range. The Federal Reserve saying it anticipates ongoing increases to the Federal Reserve funds rate. It expects them to do balance sheet reduction, quote, at a coming meeting, not specified what meeting, but specified that it is at a, quote, coming meeting. The Fed saying is prepared to adjust rates as needed relative to risks in the economy. St. Louis Fed President Jim Bullard dissented, preferring a 0.5% increase. Now, onto the Fed forecast. If I've done the math right, which I think
look how you try to gloss over that.
The median Fed official showing 7 hikes for 2022, up to 1.88%.
7
hikes forecast for 2023 and 24 for both years. That would bring the funds rate up to 2.8% both years. So the key right there is that the median Fed official right now is expecting to raise the funds rate above the neutral rate, which is 2.4% in the summary of economic projections. The Fed also, of course, hiking the 2022 inflation outlook. The median forecast now at 4.3%. That is plus 1.7 percentage points. Further, it says inflation remains elevated and says supply and demand imbalances, along with a variety of other factors, are causing it. Ukraine invasion, they say, is causing human and economic hardship. Implications of the invasion for the U.S. economy are, quote, highly uncertain. However, it is likely to create upward pressure on inflation. One more note here on the economy. They say indicators of the economy have begun to strengthen, and job gains have been strong. So good on those two scores. But I think you have to underscore that now the median Fed official does see the funds rate above the neutral rate for 2 years. Kelly?
A lot of huge developments here, and we're seeing some big moves already across the market. Steve, stay right there as we bring our panel back along with Bob Pisani and Rick Santelli. Rick, can I start with you? Some immediate moves in the bond market here.
Well, I like to watch the yield curve. That gives you all the immediacy. The yield curve tends to twos. Right before the announcement, was trading 31. Now it's trading 27. So what happened is we are seeing short maturities like 2-year and 3-year notes, even out to 5-year notes, much more responsive with the selling pushing rates higher than the long end. We're coming close to 220 in a 10-year, which was at 218 prior. So that is the move there. And if you look at the dollar index, it's rallied just a bit. And, it's in a zone of roughly a 2-year high.
Look at that 10-year
But to
rip.
me, watching the markets, listening to Steve, it seems to me that we are all putting an awful lot of faith in the market's assessment on the fly of what 2022 is going to look like by year end with respect to the Fed. And I will continue to throw it out there that whether it was 2018 or other cycles, that these things can change very quickly. Just look at December of 2019 Fed funds as the market at the end of 2018 had tightenings, then didn't want them anymore and just kicked them right back out.
Rick, thank you. Bob Bassani, your thoughts here on the markets, which we immediately saw the Dow come off its levels prior to the decision, but it's still hanging on to about a 150-point gain.
Yeah, it's pretty modest. We're down 7 or 8 points in the S&P 500. This is buy the rumor, sell the news. Powell is essentially not saying anything that people were not anticipating, playing up high
That's a
degree of
lie,
uncertainty. It looks
because
like
they said that they might thought about
they're
doing
trying to
5
maintain
hikes. Now they're
maximum
saying 7
flexibility. I think,
definitively.
he'll leave open in the presser the
That's a lie.
possibility of more than 25 basis points. Some people might be a little bit disappointed that we're looking at 7 rate hikes. That's essentially
Right,
one for
that
every
part.
meeting in 2022. But I'll tell you how confusing this is, Kelly. Half the traders down here believe the Fed is going to make a policy mistake by not raising rates fast enough to combat inflation, and the other half believe the Fed are going to make a policy mistake by raising rates too fast, too aggressively, and will induce a recession. That's how confusing things are. And remember, when you're that confusing, you stay right in the middle. It's like chess. When you don't know what to do, just push the pawn. I think he's essentially just pushing the pawn right here. And this is pretty much in line with the expectation.
Let me turn back to our panel, John, if I may. I'll call you the most
Yeah,
bearish, although
maybe
I heard
not.
David Kelly not wanting to see a lot of these hikes either. So, John, what's your reaction as someone who's worried the economy is slowing to the fact that the Fed itself now expects to raise rates a quarter point every meeting 7 times for the rest of the year?
Yeah, I think that price in particular was already in the market, but I do think that the risks are there. I
They
think
are
one thing
lying.
that you just heard is the yield curve's flat.
They were literally thinking that
as bond investors,
the Feds may not even
take that
do a
seriously.
rate hike
And I
this
think
cycle
that's
and
kind
wait
the message there is
because
clear.
of Russia and
The Fed's
Ukraine.
hiking interest rates.
They are lying.
The growth risks are there, and that's why people are buying, preferring back-end bonds to front-end bonds. So, I'm not sure that the 7 rate hikes is all that different than what the market's priced, but I do take the yield curve flattening seriously, and the risks are there. I think at some point, by the way, I think the Fed's going to take that seriously as well. The Fed is not unaware of what the yield curve's doing. And so at some point, if those growth risks materialize, that could change their tone. It could inject a note of caution. It could ultimately get them to slow down a little bit. We're not there today. That's not what's happening today. But that's certainly a possibility in the future.
That said, David Kelly, the Fed itself has acknowledged that the long end may be a 1.5 below normal because of quantitative easing and other factors. So they may or may not take the 2s, 10s as gospel here, even if it's down a couple of basis points, about 5 basis points at last check on this decision.
Well, that's right, and they can always affect that. I mean, I think this was a hawkish statement. I think that having a descent from bullard is hawkish, and I think putting 7 hikes into the dot plots. I mean, even if it were 6, it would be less hawkish, but 7 basically means that at every meeting now, the expectation built into markets is the Fed goes, and it's a very aggressive. I mean, I spent years saying the Federal Reserve shouldn't have had rates this low because they're destabilizing financial markets in the long run, but it looks like they're in danger of making the classic Fed mistake of waiting too long and then doing too much. And I'm just worried that this is pretty aggressive here for a rather uncertain economy that's going to slow down as we hit full employment.
Mona, as I listen to this, with great respect to our panelists
Wow,
here,
look at the 2 year.
it feels like a very different discussion from what people on Main Street might be feeling right now about inflation, where they're looking at this and going, we have an 8% CPI, and the Fed's talking about raising rates from basically 0 to, what would that be, about 1.5% by the end of the year. And what do you think? I mean, is that too much? I mean, markets may not be that happy about it, but is that exactly what we need to kind of bring things back into check here?
Yeah, look, I mean, consumers are certainly feeling things not only at the gas pump, but at the grocery store as well. So especially that low wage earner is feeling it more than the average American consumer. But what I will say is if you take a step back, the U.S. economy came into this crisis and this Fed rate hiking cycle with relative position of strength. So we had a healthy consumer, but we also had nearly $2.5 trillion in excess savings versus pre-pandemic levels. We were looking at economic growth in the 3 to 4% range. It looks like the Fed's downgraded that to 2.8% for this year. That's still above pre-pandemic trends above potential growth of 1.5% to 2%. So this is by no means an economy that is slowing to any sort of recessionary conditions. As the Fed tightens, if you look historically, it does take on average about 24 months to get to a recession, if you get to a recession. Not every Fed cycle ends in recession. So we do have a little bit of leeway here. And in the meanwhile, we've seen markets sell off, and we're down 10% in the S&P, 15% plus in the NASDAQ year to date. So not a bad position in terms of oversold contrarian indicators heading into a Fed cycle as well.
No, I appreciate the points. We're showing some of the yield curves there. It looks like 5s, 10s was flirting with inversion. 2s, 10s, a little bit more of the favorite one, down to about 23 basis points. But again, whether or not that's actually predictive of recession right now is a huge topic of debate. Let's turn back to Steve Leisman, who's got some more detail coming through this. Steve, we should show, these couple, look at the levels. And I think I just saw the 5 years around 220, the 10 years over 220.
Yeah, yields are popping right now.
Chart. These are some
yields are
moves.
popping right now. Everything that we've been discussing.
Two realities here. The first is the reality in the Fed statement. I want to get to that in just a second. The other is the reality that, not the reality, but the possibilities that David Kelly's talking about, the idea that it will be too much. I think that's what drags down the long end. But I want to make 2 points here. First of all, the market has very quickly priced in, the futures market priced in that 7th hike with a 63% possibility, beginning to price in that 8th hike. I can't get a great read on it, but it looks like it's pretty close to pricing in that 8th hike for February. But to me, the profound difference here is the belief by the median Fed official here that for the years 2023 and 2024, the funds rate needs to be above neutral. I don't know, maybe Larry Summers is doing a jig someplace because he just won at least part of the way. The notion that Larry laid out in his piece at the Washington Post that the Fed, and this is something we've been asking our panels about, we've been talking about for a very long time, would the Fed have to raise above neutral? At this point now, your median Fed official believes that to be the case, and I believe that to be a pretty profound shift on the part of the committee here.
Well, Steve, let's pick it up and come back to Washington now, joined again by Ivory Johnson and Jamie Cox. I saw the two of you when we talked about 7 interest rate hikes this year, both of you shaking your head when I believe it was Rick first mentioned about the yield curve coming tighter on 2 years, 2 to 10s, 5 to 10s. You were nodding. That's an important point. You don't believe that the Fed is going to go 7. They're not going to be able to hold to what they said?
No, I think the word of the phrase of the day is going to be policy error. I mean, that's the problem. They were late in 2021, and now they're going to go too fast in 2022 and perhaps even throw the economy in recession.
Well, you got to fix it, bro. You can't have it both ways, idiot.
There's a lot more going on. The economy is much different, and there's no reason for the Fed to go this quickly. They have other tools, other levers they can pull. They can bring rates where they need to be and control inflation in different ways.
How?
This is a year to keep your knees flexed across all areas.
These people are frauds, bro. They never stop with their talking points.
It's clear that Fed Chair Powell has targeted inflation as objective number 1 here, but he risks in an election year the worst of all possible fates, and that is stagflation or a recession,
right?
Or close to a recession.
You gotta stop
really
trying to pander to the stock market and fix this mess that they started.
And the big takeaway for me was a yield curve reaction. Understand that the market is already saying we don't have growth because they're discounting the time value effect. But let's go one step further. The 10 and 2 year spread on the OIS 1 year forwards was at negative 0.14%. That suggests that the yield curve might invert. And so that just gives you a sense of how little growth we have.
And we're looking at the highest yields on 2s, 5s, and 10s since 2019. Let's bring it across around third base and bring it home. What should I do with my money right now?
Well, I think if you have been involved in financials, you're going to be very happy. And, in fact, in the last 30 years, there's been a change. Actually, the last 30 years, when interest rates would rise, it would be a negative correlation to high dividend-paying stocks like utilities and things like that. Well, in 2021, that reversed a positive correlation. So there has to be some explanation for it. So partly it's because we're coming off a low base, but the other is because energy and material companies are now some of the highest yielders. So if you like the inflation play, that's actually going to be a place to be.
Quick thought from you, Ivory, before we toss back to Kelly for a market check.
I think with the economic growth slows, you want to own gold, and I'd be counterintuitive.
Gold.
I'd own gold and I'd own long bonds because when you have disinflation and expectation of lower growth, that's good for bonds.
All right, Ivory. Jamie, thank you very much. Kelly.
We want to just check on the markets, guys. The Dow has gone negative. So remember, we were up more than 200. We were up more than 500 points before the Fed earlier today. Going into the decision, we were up
The
more
typical
than 200.
pump
Fed
and
is now
dump.
down 45 points.
I always
Trump
say
is now
markets
down
are just
45
one
points. The
big pump and
S&P is
dump.
up 8.
Do never,
NASDAQ
I mean,
is up
you should
110.
never fall in love with
David
any
Kelly, quick
stock,
reaction?
any company, any CEO.
Well, I'm not surprised that the
Guys,
Dow
I
is
can't
down.
stress it
I mean,
enough.
I think this is very, very aggressive move. I just want the Fed to maintain some flexibility. I think in the long run, we've got to get rates back to positive real levels. But there's a lot of uncertainty out here. And remember, we've got a lot of financial assets which are built on the edifice of super low rates. And you can't just raise those rates up to normal levels overnight and expect nothing bad to happen. So
you kept them low artificially so long, and this bad thing happened. See these idiots, man. These people are idiots, and they got degrees in this field and don't know how to reason through logic.
John, how do you think the bond
I tell you guys, this is why we're different. This is why we know more than they do, more than they give us credit for.
Yield curves, although others may not be quite as much. You are concerned about economic growth. How should we
the
expect
bond market is telling
from
you the truth.
Long end,
they keep trying to not look at the truth.
Home loans, how should we expect that
look at them the 2 and the 10s.
How should we expect credit markets?
The
high
5 year
looking pretty good today prior to this meeting. Give us your sense of how markets are all going to shake out here.
Yeah, you know what it's going to be.
So I think there's some value there. I think there's some value because, you know, even the Fed's saying 7 hikes and now the market's pricing 8, if I heard correctly. You know, I do think long bonds do provide some diversification. And then finally on credit, you know, credit spreads have widened. Their prices are a little bit cheaper than they were at the beginning of the year. And if we can avoid the Fed policy mistake, and I think that's the big question, there's a lot of time between now and the end of the year for the Fed to get this right. If we can avoid that Fed policy mistake, you know, I think you will realize some value in credit. So yields are higher, spreads are wider. You know, I think you need to be looking at this as an opportunity.
All right, Mona, what would you add to that and to investors looking at stocks here and wondering, okay, you know, we see often kind of a three-act play in response to the Fed. We get what happens in the first couple of minutes, sometimes predictive, sometimes not. We get what happens between the decision and Powell. Sometimes predictive, sometimes not. Then we get the act that begins after we hear from Powell and often lasts into the coming weeks. So how much should we make of what we're seeing thus far?
Yeah, you know, the immediate reaction isn't usually what happens over the long term. What we will say is in some ways the Fed is being smart here, putting out 7 rate hikes at a time when the economy is still, you know, somewhat more resilient, and then being able to pull that back if needed. I think that would actually be supportive of markets over the long term. But in the near term here, we do think that some of the overhangs that the market has been worried about, they wanted clarity from the Fed. They're starting to get that, and we'll see how Jerome Powell talks through the conference today as well. We are also seeing a little bit more hope around a diplomatic solution to the geopolitical crisis. So if both of these overhangs are lifted, or at least we get a little more clarity in the weeks ahead, we do think that some of the, the correction that we've seen in the market, we could get a rebound with, you know, some of the safe havens reversing, some of the commodity prices rolling over, and perhaps, you know, finally some of that reopening 2.0 as the pandemic trends here in the U.S. at least improve. The value cyclical parts of the market start to improve as well. And financials is certainly part of that as the Fed is moving.
All right, as we watch this all play out, let's turn back to Rick Santelli. Rick, as the bond markets digest these moves.
Yeah, I think it's very fascinating to see 3s, 5s, 7s, and 10s all are having a traffic jam as they get their yields closer and closer. Of course, 7s to 10s have a minor inversion. They had a minor inversion back in February, a minor inversion in 2008.
Man, that 2 year is
but
popping.
then again, it's a
look at that 2 year ripping.
7s just aren't as liquid, just like 20s. 20s have had the highest yield on the curve for a while. It's a liquidity issue. But I think we're all losing sight of one big thought. And that thought is the curve's going to get flat as a pancake, and it's going to see all short rates gravitate to the 10-year rate, which my guess is going to be around 2.5%. More importantly, we are witnessing something historic. The end of globalization, the end of just-in-time inventory, and all of that is crashing in a post-COVID Russian invasion type world. And what it means to me is you could talk about stagflation, name it anything you want, but labor costs, energy costs, and housing costs aren't going to be moderating anytime soon. That's food and energy will take on a monumental meeting in the quarters ahead.
Facts.
All right, and finally to Bob Pisani with a last thought on stocks here, Bob.
Well, we were up 40 on the S&P, now only up 10. The Dow.
This guy right here, complete promo bull.
I said earlier, the problem
cheerleader, downplayer of reality. Bob Pisani is a straight shield.
They're going to be so aggressive, they might induce a recession. They're acting like this is a little bit on the aggressive side. The 7 rate hikes this year, the 2.8% for 2023. So we'll see. But it's like said, this is a very difficult situation. It's not clear how well and effective they're going to be combating inflation, and at the same time, they may eventually stall out the economy. I think you're going to see a lot of demand destruction this summer around things like gasoline. We're already seeing about around used cars right now. That may help slow inflation down and slow the Fed down itself. A little demand destruction.
All right, Bob Bassani, thank you. We'll check back in soon. And a real big thanks to our panel guys today. John Bellows, David Kelly, Mona Mahajan, standing by to walk us through this big Fed decision, a historic one with the first rate hike since the end of 2018. Coming up, former Fed Governor Randy Kroszner joins us with his analysis of the Fed's decision, his outlook for the pace of tightening and the risk of recession. Fed Chair Jerome Powell's news conference.
All right.
Past the hour, we will have live coverage here with the Dow up 44. We're back.
So Jerome Powell's getting ready to speak here shortly. So let's do this real quick here. Let's switch gears for a hot second, right? Again, you guys got to mind me. Y'all know I kind of get animated like I'm watching a boxing match here on the screen. I be having to talk to the screen, right? Because these people are just talking hot garbage for the most part. They're pushing the consistent narrative like they always do, and that things are fine. But it's fine for them. It's not fine for everybody who are really out there, weathering this storm. And again, they just witness again, $14 billion of their money go elsewhere. That money is not going to combat prices at the oil pump, at the gas pump. They're not going to combat, the higher price that we're paying at the grocery store. That $14 billion that's given away, right, to Ukraine, right? There, I said it. That money is not going to help people with their energy and utility bills. It's not helping people with their rent, their mortgages, right? Their child care. Again, people not going to get me caught up in this old ignorance of, well, see, it's, you got to do, bear your cross to be in here. Like, get out of here with that goofiness. Like, we grown people over here. We're adults. We're seeing things happen in a way where that they're pulling a flim flam on you. We know that they're pulling these, these 3-card monthly, tricks on people and got people really falling for this ignorance while they backdooring money into all these institutions except your bank account or into your, your community, right? It's to the point now where it's just not even, look, it's comical at best, right? For a lot of people to keep them from really, really going ham. Because a lot of people who are so, again, they're lost in the weeds because they're, they just buy anything that people sell them. They'll listen to these people get on these platforms and, again, these corporations. Like, seriously, you're getting your news from people who have a vested interest to control your narrative. It's like a Facebook who's selling your data. Now they're blocking, people from ability to have, speech and free speech. And you couldn't make this stuff up. Could not make this stuff up. But anyway, so yeah, let me get the link out real quick, guys. We're going to listen to Jerome Powell when he comes live. Anybody want to come on the panel? Again, I don't have that much longer here, but we're going to make the best of this time while we can. Let me get this here. Let me get this here. There's the link, guys. If you want to come on really quick, if you got anything to say, add to this today in terms of dealing with the rate hike, quarter basis point that we have on the books as of today, with 7 rate hikes are in alignment for the rest of the year, potentially, given the fact that if things, whatever, stay the same at this point, I guess, of them, assessing what Russia may do and assessing what the broader global community will look like, given the fact that we have China who's going back into lockdown to fight new cases in COVID. Again, it's like, yeah, good luck, right? But for the most part, we know one thing. This inflationary bug is going nowhere. And until you slam on the brakes of all this, jubilee spending or this, that, and the third, we're going to be here. We're going to stay here. And it's not going to get better. So I just say, hey, so be it if Wall Street can't go to all time. And so be it if it forces people to be a little bit more cautious with their spending now and really buy the things that they need more so than the things they want, so they don't have to worry about having that problem later on down the road because, again, the Federal Reserve caused this problem. The administration caused this problem. Trump and Biden together caused this. So, yeah, it is what it is. But I don't want people to get the wrong impression, that, this is somehow, if you will, somewhat, hyperbole to the degree where we all should just be comfortable in this setting. No, this stuff was already laid out. It was purposeful in the way that they implemented it. We know that. Why? Because we've been tracking it. We've been following this stuff for years now as investors. This is what we do. We track the data. We track the information, the money flow, the money supply, M1, M2. We see what's going on with the Fed's fund rates. We see what's going on when it comes to, again, economic growth from, exporting partners and this, that, and third. Again, it's not hard to see exactly what's going on once you realize what they're doing. And it's been a sham from the beginning. And it's the reason why America is such as a debt-laden society, where they're just using power as a way to try to dominate people who have actual real resources. And it's not even, again, it's funny. We're not producing nowhere near what we need to sustain. If it ever came into a crisis where we had to lock down our borders, we would go under, literally. We would go under. Maybe in two or three quarters, we'll be in trouble. Why? Because we pretty much sold all our manufacturing rights, our agricultural rights, for the most part, again, to other people. And now we're just a helpless society that just want to bully people through military, aggression. Again, y'all get it. Anyway, Oba Chris, you're in the building. Peace, power, profit. Oba, how you doing today, man? What's on your mind today, Oba?
Peace, power, and profit, Oba. I'm doing well. Just listening to, the lies, the blatant lies. They just don't want their heaven to end, man. That's all it is.
Good point.
All that extra money that they go up to the Hamptons, or wherever they going, they got to give up some of that now, because the party is over. It's time to crash the party. Everybody got to go home, and that's the reality. They don't want to deal with that. They want the party to
they don't
keep
have
going.
enough at this point, right?
Right.
As if
they
didn't
greedy,
get
man.
Enough.
They greedy. They greedy as hell. They don't want to share. They don't want to give up nothing. They want to, let things continue. But we all know that that's not a reality. It's always going to come a crash. A party's going to get crashed, and stuff got to go back and reset. That's just a reality things. So they just don't want to give up that extra money. Once you got that extra money coming in so much, when it's time to be taken away, now you got to start thinking about spending, as you said earlier. You got to be a little bit more cautious with your spending. You got to buy what you need instead of your wants. So, so what, they don't get to go to the Hamptons, 6 times a year, coming in the next years. You know what I mean? Screw them, man. They greedy. You know what I'm saying? You profiting off our backs and our money. How dare you even have the nerve to get upset about a reset?
That part of all things, right? Again, this the extent of how, again, that's why we are in this space. I tell people, I have it no other way. Like, who wouldn't want to know the intricacy of how this system really works? Why? Because it has shown to be resilient only because their ability to hide things, downplay things through benign neglect. Again, y'all know the whole policy, how America gets down. Again, incite war because it's a benefit that they get to print more money to do things with it outside of giving it to the American people. They take from American people and tell you to be happy and supporting this foolishness by pushing a whole lot of propaganda to get you on board psychologically, while they go in your back pocket and take money from you through tax dollars to give it again. War machines, everybody else that don't look like you, people try to come into your country illegally. Again, everything except doing the right thing in terms of repairing the society as a whole, fixing things in a way where we can have a better quality of life. Again, before we even get to the ideal of reparations, again, we just saw them give Afghanistan people $6 billion. They're giving the Ukrainian people $14 billion. They tried to get those Mexican illegals that was coming in on the border, billions of dollars of taxpayers' money, and they don't got 1 penny for reparations.
Facts.
They don't have pennies for reparations.
Facts.
Again, it's the extent of how ignorant that people will sit here and just buy into this, and they want you to be like, no, bro, but this is a part of just, being in America. And you hear this part here, Chris, man, they the president. They can't do nothing, man. They hands tied, but they can't do nothing for you.
Right.
How many times we've heard that lie? I'm so sick of hearing ignorant people come up to me with their little voting stickers on, so I voted. And then you say, well, what have the administration done for you? Well, it's not their job to do that for us individually. They have to, their hands are tied. They can't do that. And yet, it's still every day you come to the TV, here come another 14 billion for this country. Here comes another 20 billion for this nation. Here comes another 20 billion for these people coming in through your borders illegally. Here come another 6 billion for people who were just shooting bombs at you, rockets at you, and now you're finna give them money because you botched going in their country trying to overtake them people. Now they looking at you funny and say, "Oh, y'all finna give us houses, give us money, and bring us to your country." Like, man, look, I'm just saying, I'm just saving money for me a ticket for one of them Elon tickets.
Yeah.
I'm saving money for one of them Elon tickets, bro. Just drop me off at the nearest planet, bro. I'm straight. I figure the auction thing out on my own. I take my chances with the ancestors or something. I don't know. Look here, bro.
Real talk.
But anyway, again, I don't want to come off as I'm on the soapbox, but this is the stuff that we have to deal with. Why? Because if you are a logical person, you will walk around with a level of insanity, circulating your head for the most part, despite the decorum that you would think people always have to operate under. That's a big facade. Like, who holds in all that kind of information and knowledge then walks around with a smile on their face? Like that's the biggest front cap of all time, right? To live a lie and be comfortable with it, knowing everybody looking at you like, you took your, did you take your lie pill today? You hide the lie pill today? Like, no, we don't take those pills over here, bro. Right? We're not living under the pipe dream where someone gonna come and censor you tomorrow because of the fact that you told the truth. Like, no, this is the whole point of becoming financial literate, to become an entrepreneur where you can make your own money, right? You don't have to let people, tell you in and everything, and you just go for it, like a gopher, as they say back in the old days, right? You're a gopher turtle, right? Like, no, this is what we've been working hard for, studying for, trying to be, independent of a system that's shown to be irresponsible with your finances, your dreams, your hopes, your goals, your quality of life, right? That's just from my opinion. Again, I'm not trying to, impose my views on anybody. Every man has to make their own stand. Every woman has to make their own stand. But I tell you one thing, if you don't stand for something, you're going to fall for anything. Anything. Right? And so that's why we're here to have this conversation. I hear $1 Will in the bill. I see you, family. What's peace, power, and profit to you? Right? Over Rich in the bill. I'm just coming to the YouTube side. Forgive me, guys. What's going on? Ilba Tamika in the house. We see you guys in the house. Peace, power, and power for everybody. Jack Ole in the building. We see you as well. Over T-Bone in the building. We see you, family. Who else we got in the building? Over Chris on the panel, of course, is always holding it down. Go subscribe to the YouTube channel, right? Go subscribe to Chris Logics. Matter of fact, post it in the back chat when you get a chance, Over Chris. Okay. Let people subscribe to you. Our brother P Smooth in the building, right? Peace, power, profit. You Over Rich in the building, right? Rich boy in the building, right? Y'all know him as Luther Haynes in the building. Shout out to him, brother Matthews in the house, brother Brandon in the building. Peace, power, profit. Our Over Sean in the building, brother Be Humble in the house. Over Sonny's in the house. Ilba Angie in the building. Anybody that might be listening on the backside as well that may not be typing, we appreciate your view. We appreciate your opportunity to be here today to have this surreal discussion. Why? Because we've been planning for, talking about this stuff. We've been planning for it. We've been waiting for this moment to happen. We know that the markets are in a very unusual place. Why? Because it's so busy trying to convince people that this is normal behavior and you need to be just risk on willy-nilly and not worry about any of these things. Like, oh, it's priced in. This is priced in. This is priced in. That is priced in. Like, are you kidding me?
Right.
Like you could make this stuff up. The insanity, the level of, like you said earlier, bro, because you said it, I couldn't have said it any better. It's the greed. It's the level of greed that these people have made all this money and they can't stand the fact that now they have to back away from the dinner table just a little bit, at least, and let the broader society get a chance to eat a little bit too. And we know that's not going to really happen because why? These people are going to do like they always do in Congress down here in the Washington area. They're going to go before panels and committees and have people petition for things, and then their paperwork going to get put into a perspective and pushed to somebody side of their desk, and nothing going to get done because the gridlock between the Democrats and the Republicans are always going to be quid pro quo. If they can't get that out of it, the hell with trying to give something to the American people. which is their money. It's your money. They're taking your checkbook and spending it on what they want.
Right.
That's essentially what's happening every day in this country. And people don't know how to deal with that. They don't even know that it's happening for the most part because they don't know how to track the data. They don't go hang out on the Federal St. Louis website and see all these things, that are moving when it comes to their economy, their money, their savings, their future bills or lack thereof. I mean, the national debt is at $30 trillion, like for seriously, for seriously, right? And again, with all that debt, you would say at least if they took all that money and paid it into the future, somebody got to be living good, right? When we look around, it don't seem to be, and a lot of people who really need it, they don't seem to be having a good quality way of life. That's just my opinion. Again, I'm not trying to whatever. But anyway, so there we go, guys. 25 basis point, the Federal Reserve. Here comes Jerome Powell. Let's listen to this. Let's listen to this shield. Here we go. All right, let's crank this up here. 1 second. Forgive me real quick. My bad. Let's listen to Jerome Powell give you a good let's hear him, put you to sleep. You know it's coming. You already know it's coming.
Do to support a strong labor market is to promote a long expansion, and that is only possible in an environment of price stability. As we emphasize in our policy statement, with appropriate firming in the stance of monetary policy, we expect inflation to return to 2% while the labor market remains strong.
2%, we're at 15% right now.
Inflation is likely to take longer to return to our price stability goal than previously expected.
Goodness.
The median inflation projection of FOMC participants is 4.3% this year and falls to 2.7% next year and 2.3% in 2024. This trajectory is notably higher than projected in December, and participants continue to see risks as weighted to the upside. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. Our policy has been adapting to the evolving economic environment, and it will continue to do so. As I noted, the committee raised the target range for the federal funds rate by 1/4 percentage point and anticipates that ongoing increases in the target range will be appropriate. The median projection for the appropriate level of the federal funds rate is 1.9% at the end of this year, a full percentage point higher than projected in December. Over the following 2 years, the median projection is 2.8%, somewhat higher than the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now.
Boy, he's trying to tightrope.
Reducing the size of our balance sheet will also play an important role in firming the stance of monetary policy. At our meeting that wrapped up today, the committee made good progress on a plan for reducing our securities holdings, and we expect to announce the beginning of balance sheet reduction at a coming meeting. In making decisions about interest rates and the balance sheet, we will be mindful of the broader context in markets and in the economy, and we will use our tools to support financial and macroeconomic stability. As we noted in our policy statement, the implications of Russia's invasion of Ukraine for the U.S. economy are highly uncertain. In addition to the direct effects from higher global oil and commodity prices, the invasion and related events may restrain economic activity abroad and further disrupt supply chains, which would create spillovers to the U.S. economy through trade and other channels. The volatility in the financial markets, particularly if sustained, could also act to tighten credit conditions and affect the real economy. Making appropriate monetary policy in this environment requires a recognition that the economy often evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. We are attentive to the risks of potential further upward pressure on inflation and inflation expectations. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Let's go to Gina at the New York Times.
Hi, Chair Powell. Thank you so much for taking our questions. I wonder if you could detail your thinking a little bit about how you're considering the risks of going too fast and potentially tipping the economy into recession, and how you're weighing those risks against the possibility of going too slowly, allowing inflation to become embedded and kind of getting behind the curve.
So I guess I would start by saying that in my view, the probability of a recession within the next year is not particularly elevated. And why do I say that? Aggregate demand is currently strong, and most forecasters expect it to remain so. If you look at the labor market, also very strong. Conditions are tight, and payroll job growth is continuing at very high levels. Household and business balance sheets are strong. And so all signs are that this is a strong economy, indeed one that will be able to flourish, not to say withstand, but certainly flourish as well in the face of less accommodative monetary policy. So I guess that's how I would say I'm looking at that. Of course, the objective is to achieve price stability while also sustaining a strong labor market, and that is our overall objective. But we do feel the economy is very strong and well positioned to withstand tighter monetary policy.
Thank you. Let's go to Howard at Reuters.
Hi, Chair Powell. I was wondering, in the steps, you have quite a markdown to GDP from 4 to 2.8%. I'm wondering how much of that do you feel is a result of the Fed's stiffer than expected action here? We talk about monetary policy operating with a lag, but is this going to bite quicker than expected?
I don't think that's a big piece of it, actually. I think some of that is just an early assessment of the effects of spillovers from the war in Eastern Europe, which will hit our economy through a number of channels, highly uncertain, but you're looking at higher oil prices, higher commodity prices. It'll be so that we think that will weigh on GP to some extent. So that's part of what moved those assessments down. I think generally monetary policy works with a lag, so some of that would also be in there. But remember as well that 2.8% is still very strong growth. If we think that the potential growth rate of the economy is somewhere around 1.75%, 2.8% is strong economic growth. It would have been one of the strongest years, in fact, of the last expansion. So while it's lower than last year's 5.8%, it's still quite strong growth. So I would say it's quite a strong forecast.
So in that context, what would trigger you to go faster or slower on the rate hikes? Ongoing increases doesn't really tell us whether this is going to come in bigger chunks or evenly paced through the year.
Yeah, so the way we're thinking about this is that every meeting is a live meeting, and we're going to be looking at evolving conditions. And if we do conclude that it would be appropriate to move more quickly to remove accommodation, then we'll do so. I can't be perfectly specific about it, but that's certainly a possibility as we go through the year.
Thank you.
Thank you. Let's go to Rachel at the Washington Post.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm curious if you can be specific on when you expect to see inflation will start to come down, especially with the combination of rates going up, fiscal aid dissipating from the economy, and supply chains getting better. And if you don't start to see that, how will you signal it? What will you be looking for, and what will you be looking for over the course of the year? Thank you.
So I guess I would say that before the invasion of Ukraine by Russia, so let's go back to that. I would have said that the expectation was that inflation would peak sometime in the first quarter, maybe the end of the first quarter of this year.
Lies.
And maybe stay at that level or a little bit lower and then start to come down in the back half of the year. So now we're already seeing a little bit of short-term upward pressure in inflation due to higher oil prices, not natural gas a little bit, but not so much for us since we have our own natural gas supply, other commodities prices. The other thing is that you're seeing supply chain issues around shipping and around, lots of countries and companies and people not wanting to touch Russian goods. So that's going to mean more tangled supply chains. So that could actually push out the relief we were expecting on supply chains generally. So I guess I would say that the expectation is still that inflation will begin to come down in the second half of the year. But if you look at where I read the SEP headline median, we still expect inflation to be high this year, lower than last year. And then we expect, though, particularly with the effects of the war, but also the data we've seen so far this year, we expect inflation to remain high through the middle of the year, begin to come down, then come down more sharply next year.
Next year. But he just said, how you have
Nick at the Wall Street
all right,
Journal.
I'll leave that alone. Let me just be quiet.
Nick Timmeros of the Wall Street Journal. Chair Powell, over the last 6 months, the Fed has shifted its policy stance quite a bit. 6 months ago, you were still buying assets. Most officials
He just
weren't
bought
projecting
assets
any
literally
interest rate
last
increases
month.
this year.
Right.
And yet,
And a
despite
portion
the
of this
shift
month.
over the last 6 months, real rates are as negative today as they were then. So how concerned are you that further inflation surprises will offset the effects of recent policy firming by leading real rates to stay at levels that do not actually provide much restraint to the economy?
Go to all these old softball
So
questions.
that's one of many ways of capturing the situation, which is that the committee really does understand that the time for rate increases and for shrinking the balance sheet has come. And I would just say, I would go back to the economy is very strong. As I mentioned, tremendous momentum in the labor market. We expect growth to continue. It's clearly time to raise interest rates and begin the balance sheet shrinkage. And I just wanted to say that as I looked around the table at today's meeting, I saw a committee that's acutely aware of the need to return the economy to price stability and determined to use our tools to do exactly that. You couched it in terms of real rates. I would say if you look at the SEP, you've got people getting close to or even above, in many cases, their estimate of the longer run neutral rate. So I understand that doesn't do it for real rates, but if you go out a year or two, many people are in their forecasts are having tight policy from a real interest rate standpoint. So that's something that we're focused on. Of course, it's a highly uncertain environment, and we don't know what's going to happen, but we do know that we're going to deploy our tools to achieve our goals, and that includes the price stability goal.
Let's go to Victoria at Politico.
Hi, Chair Powell. So looking at the summary of economic projections, you all have inflation coming down over the course of the year to 4.3%. And then you also have rates going up to what appears to still be below roughly what would be estimated to be the neutral rate, although I know that's a little bit uncertain. So I was just wondering, how much of inflation coming down do you see as actually being as a result of the Fed itself raising rates? And then also, if I could just ask, given that Sarah Bloom Raskin withdrew her nomination, what do you expect to do with the regulatory portfolio? Do you expect to assign a governor in charge of that?
Okay. So sorry, tell me again your first question.
My first question is, how much do you expect inflation to come down as a result of the Fed's actions?
Okay, so part of inflation coming down at the very beginning is clearly to do with factors other than our policy, and those would include potentially the supply chains getting a little bit better. Certainly, base effects. You're lapping, as you know, when you look at a 12-month trailing window, you're lapping very high inflation in March, April, May, June of last year. So there should be some effects from that in the 12-month picture. Really, what we're looking for though is month by month inflation coming down, and so it's really it's all the things we've been talking about. That really haven't helped much, including the shift away from goods and back to services, including supply chains getting better, including labor force participation, all those things that have been sticky and not happening. But a big part of it is the base effects I mentioned as well. I think monetary policy starts to bite on inflation and on growth with a lag, of course. And so you would see that more in 23 and 24. But also remember, we started talking about rate increases last year. For some months now, financial conditions have already incorporated.
There you go, dog whistle to the stock market. He dog whistling.
It doesn't start today. In effect, the moves are already priced into the market for a few months now. So
there you go,
so
dog
the clock is
whistling.
running on
There
that.
it
And
is.
I think some of that will be seen in the second half of the year as well. And on the regulatory portfolio, I would just say this: we have an obligation to carry out under the law in supervision and regulation, and we're doing that. That's what we're doing. The committee is not active, so what's happening is things are coming to the full board, and we're voting on them. We're getting our business done. We got the stress tests done. We've looked at a number of proposals for mergers and things like that. So we're working ahead. Of course, we don't have a vice chair for supervision, as you mentioned, but we're making do with the situation we have, and a good number of things have come straight to the board for approval.
Let's go to Neil Irwin at Axios. Let's go to Neil Irwin.
Hi, Chair Powell. It's Neil Irwin at Axios. Thanks for taking our questions. In the statement of economic projections, we see a forecast of median 1.9% Fed fund rate at the end of the year, 2.8 end of next year. Wondered whether that aligns with your own expectations, in particular on that point of overshooting the long-term neutral rate. And also, if you can tell us anything about how that might be paced, front-loaded, back-loaded, how high is the bar for doing 50 at one meeting?
So I don't, Neil, I've never talked about my own SCP projection. It's in there, but I think Fed chairs have generally not done that because we just haven't done it. It's because we have to put together the consensus on the committee and present that consensus. So I wouldn't talk about my individual one. And in terms of the pacing of it, I would just point out that there's 7 remaining meetings this year. This isn't something we discuss or debate or agree on, but there's 7 remaining meetings and there's 7 rate hikes. I would add there's also the shrinkage of the balance sheet, which people do the math different ways, but that might be the equivalent of another rate increase just from the runoff of the balance sheet.
Well, you hate to say that.
I don't know. We haven't made any decisions.
$9 trillion sitting on their balance sheet of taxpayers' money that has holding the stock market up. $9 trillion.
If you look at the SEP, a good number of participants do see more than 7 rate increases this year. And
you heard that?
I can't give you. I'm not going to try to give you a really specific test for what
people sitting on the reserve on the central bank reserve board with him
the data as they come in,
want more hikes.
Looking to see whether the data
he refused to listen to him.
Expected improvement on inflation. We'll be looking at the inflation outlook and making a judgment. And we'll be going. Each meeting is a live meeting, and if we conclude that it would be appropriate to raise interest rates more quickly, then we'll do so.
Boy, you hate to say that. He hate to say that. Tragic, boy. Tragic. Tragic what they're doing with y'all money. Unbelievable. Something happened to their mic over there, guys. I don't know. Something happening with their mic over there on their side.
As we wait for Chair Powell to continue his press conference, let's just quickly check on markets. We're down up about 50 points, and it's really been jumping around here. We were up more than 200 prior to the decision, top of the hour to hike rates. About a 0.1% gain. S&P's up 30, Nasdaq's up 221. All the talk focused on the bond market, where the 5-year yield has been flirting with levels above the 10-year yield. Not necessarily any macro significance there, but no one ever likes to see inverted curves. 2.22% on the 5-year, 2.21 on the 10-year, just under 2.5% on the 30-year. And you heard Chair Powell there repeatedly emphasizing just how much he thinks the committee is serious about returning to price stability. To use his quote there, he said he looked around the table and saw a group of people who were committed to price stability. He several times, including in that response, said there were some Fed members who wanted to do more than the 1/4 point hike per meeting this year. He said if conditions warranted, they would absolutely look at doing more. So pretty explicit language there about what they would do if the outlook evolves as they see it. And he also mentioned, by the way, his 2.8% growth view he views as pretty bullish. Let's go back to the chair.
Was as high as it was July of 1981 when the effective federal funds rate was 19.2%. But given the current data, how far behind the curve of inflation do you believe the Federal Reserve is?
That part. Good question. Here we go. Yeah.
I just would say a couple of things.
Here it comes. Keeping it alive. Here it comes.
We have
there
the
you
tools
go.
that we need, and we're going to use them. And as you can see, we have a plan over the course of this year to raise interest rates steadily and also to run off the balance sheet. We will take the necessary steps to ensure that high inflation does not become entrenched while also supporting a strong labor market. As I mentioned, if we conclude that it would be appropriate to move more quickly, we'll do so. I leave it to others to make the judgment you ask for.
And then just as a follow on that, I wanted to get you on the record on this. What impact has there been on your job, given the fact that
all of a sudden now he got bad.
Lost you in the middle of the question.
Here we go.
Edward, can you repeat that question?
the impact that given you're not actually confirmed and Governor Brainerd is not actually confirmed, has there been any impact on your job or the Fed's ability to handle inflation?
None whatsoever.
Okay, let's go to Colby Smith at the FT.
Thank you, Michelle. Chair Powell, how concerned is the committee about the notable pickup in services inflation, which is perhaps less likely to self-correct?
I'm not going
and
to trade this trash.
Both the committee's confidence that long-term inflation expectations will not de-anchor in the coming months, as well as the balance of risk that the Fed may need to raise interest rates further above neutral than indicated in the dot plot. Thank you.
Thank you. So, of course, that's something we're watching report by report, and we noticed it in the last meeting, and it's part of the overall picture. We have expected services inflation to move back up to where it was, and that's part of what's happening. Is in the case of some services, prices are still getting back up to where they were before the crisis. In other cases, it's pretty clear that inflation has spread more broadly across services, and yes, that is concerning. In the meanwhile, we see some progress on the good side, but really in this latest report, it was confined to vehicles, which is admittedly a large category. So, as I mentioned, the committee acutely feels its obligation to move to make sure that we restore price stability, and is determined to use its tools to do so.
Thank you. Let's go to Steve Leisman at CNBC.
Thank you, Mr. Chairman. I wonder if you could help me understand the kind of logic, if there is one, inside the SCP here. As I look at the median forecast, for example, for unemployment, it runs for the 3-year window below the long run rate. I look at inflation above over the 3-year window, the long run, or call it the neutral rate, so the economy still runs hot. And that is all true in a regime when you run, at least for 2 years, the funds rate above the long run rate. I guess my question is this: are you not give a forecast here that essentially suggests you will be continuing to run further behind the curve and never really get in front of inflation, because the economy will continue to run hot?
Exactly.
Kind of on a related issue, you said earlier.
Good question, Steve. Listen, for once,
inflation will take longer to return to price stability than we had originally expected. Isn't that a choice you're making? And if so, why are you making that choice to let inflation run above price stability longer than you'd like?
Right. So if you look, first of all, you're looking at medians, but understand that it's not something we voted on. It's not a plan. But if you look, people do have their by the end of this year, broadly, people are at or close to, or in some cases above, their estimates of longer run neutral interest rate. Okay, so that should stop pushing. That should, in other words, that should be a removal of accommodation for monetary policy, basically. At the same time, we will have done significant balance sheet runoff, and you can think of that as further. In the next year, and just looking at the median, you're now above the what people estimate to be the longer run median. So also in many people's forecasts, that actually amounts to tight policy in real rates as well. So why does unemployment remain at 3.5%? You know, I mean, a couple points. One is the connection between in the economy we had before the pandemic, the connection between inflation and the level of the unemployment rate was not very tight. But this is clearly what this is an expectation that really it amounts to that the idea that wage increases, which are now running above the level that would be consistent over the long run with 2% inflation, will move back down to levels which are still very attractive, full economy kind of, full employment kind of wages, but not to a point where they're pushing up inflation anymore. And as I mentioned, there are a lot of factors causing inflation to come down. And you know, the reality is there are many moving pieces, and we don't know what will actually happen. But no matter what happens, this is a committee that is determined to use its tools to make sure that higher inflation does not become entrenched. And so we are determined on that front, and we'll deal with what comes. This is a modal or most likely expectation, but we'll deal with what comes, whether it's better or worse.
Thank you. Let's go to Chris Rugaber at the AP.
Hi, thank you. Well, let me follow up a bit on that. I mean, there are a lot of economists skeptical that you can reduce inflation as much as you've penciled in without raising the unemployment rate. And I'm wondering just what are the mechanisms you see in reducing demand? I mean, outside housing and autos, how do higher Fed rates reduce consumer demand unless it's through higher unemployment? Thank you.
Well, if you take a look at today's labor market, what you have is 1.7 plus job openings for every unemployed person. So that's a very tight labor market, tight to an unhealthy level, I would say. So in principle, if let's say that our tools work about as you described, and the idea is we're trying to better align demand and supply, let's just say in the labor market. So it would actually, if you were just moving down the number of job openings so that they were more like 1-to-1, you would have less upward pressure on wages. You would have a lot less of a labor shortage, which is going on pretty much across the economy. We're hearing from companies that they can't hire enough people. They're having a hard time hiring. So that's really the thinking there. Is these are fairly well understood channels, interest sensitive, and basically across the economy, we'd like to slow demand so that it's better aligned with supply, give supply at the same time to recover, and get into a better alignment of supply and demand, and that over time should bring inflation down. And I'll say again, though, we don't have a perfect crystal ball about the future, and we're prepared to use our tools.
Y'all
as
print
needed
money like you
to
did.
restore price stability. As I mentioned in my opening remarks, without price stability, you really can't have a sustained period of maximum employment. It's one of our most fundamental obligations is to maintain and restore, in this case, price stability. So we're very committed to that.
Straight dumpster fire
is to restore price stability while also sustaining a strong labor market. That is our intention, and we believe we can do that.
They just kept printing, and all of a sudden now they ain't got a crystal ball.
Okay, let's go to Scott Horsley
As if they
at
knew
NPR.
the damage wasn't going to be catastrophic at a point where they did not stop and get in front of the sweat.
Same ground you just
issue
talked
stands
about,
behind
Mr.
it.
Chairman. I think I missed some of your answer there, but I have a follow-up question on the labor force. We have seen some gains in the prime age workforce in the last few months. I wonder what you anticipate when it comes to some of the older workers as the health outlook has changed. Are we going to see more recent retirees following Tom Brady back in the workforce? And what would that mean for wages and inflation?
It's hard to say. What we saw in the last cycle was that over the course of a long, steady expansion, labor force participation outperformed expectations. And that was just it was a tight labor market, but it was nowhere near as tight as this labor market, but it was a tight labor market. And so people stayed in the labor force longer. It wasn't so much people coming back in the labor force after retirement. That's not something that happens in the aggregate very much. But so that's what was happening. And, more labor force participation is tremendously welcome. And of course, our policy does not in any way preclude that. This is a situation where wages have moved up at the highest rate in a very long time. And people are able to quit their jobs and move to better paying jobs in the same industry or different industries. So
I need to update this meme. This ain't even updated. It's higher than 7% now.
As we get past
how are people higher wages?
Truly, it becomes an even more attractive one. So we hope that will lead to more labor supply. That's a good thing for the country. It's a good thing for people. And it also will, we think, help relieve some of the wage pressures that do put inflation more at risk. That last part is we'll have to see whether empirically it works out that way. But in principle, it ought to help with inflation as well. It's not the only thing we're looking for, though, from inflation. We're looking for help from a number of different places, and most importantly, from our own policy.
Okay, let's go to Rich Miller at Bloomberg.
Thank you, Michelle, and thank you, Chair Powell. I'm sorry, I'm having some communication problems, so I've missed some of the stuff you've said, and my apologies if this has been asked. Since the FOMC met last January, financial conditions have tightened markedly. Equity prices down, treasury yields up, bond spreads risen, yield curve is flattened a lot, and even further this today, dollar's up. Is that welcome? And would you like to see more in order to achieve your goals? Thank you.
So as you know, policy works through financial conditions. That's how it reaches the real economy, by just the mechanisms you mentioned. And remember that the financial conditions we had for the last couple of years were a function not only of very aggressive and appropriately so fiscal policy, but also highly accommodative monetary policy. The monetary policy settings that we put in place at the worst parts of the pandemic. So it is very appropriate to move away from those. And yes, that will lead to some tightening of financial conditions in the form of higher interest rates and just the sorts of things. We're not targeting any one or more of those things, but financial conditions generally should move to a more normal level, so that because we know the economy no longer needs or wants these very highly accommodative.
They didn't want them literally 8 months
it's
ago.
Time to move to a more normal setting of
and
financial.
You kept printing, dude. Are you
conditions,
kidding
and we
me?
do that by moving monetary policy.
This is why you're dealing with
to
inflation
more
right
normal
now,
levels.
because you just refuse to listen to real data points. Like these people are straight frauds.
Financial conditions that tighten further,
and they supposed to be professionals, not they supposed to be professionals, guys. These people frauds.
So I would say we look at a broad range of financial conditions.
Oh my goodness.
And of course, when we tighten monetary policy, we do expect that they will adjust in sync over time with monetary policy. It's not any particular financial condition, but a broad range of financial conditions. They will reflect, to some extent, they reflect any number of things.
They milk COVID long as they could to print more money
to
real not necessarily do what they needed to do to protect people who needed it the most. That's all they did with milk COVID. They milked it.
Remove accommodations.
That's what government, man, these people frauds.
Broader financial conditions will also be less accommodative.
They were too busy to just print money.
Thank you. Just a little housekeeping note. Those of you in this call may be having some tech issues. If so, I understand the broadcast is coming through clearly on www.federalreserve.gov. So you might go there for the audio. And now we'll go to Jean Young.
Hi, Chair Powell. I wanted to ask about the balance sheet discussion you've had at this meeting. Can you give us any more details? Did you discuss whether to cap runoffs or whether to increase those caps over what period, if there were any details?
Yes, thank you for asking. So at our meeting today and yesterday, we made excellent progress toward agreeing on the parameters of a plan to shrink the balance sheet.
Excellent progress.
We're now in a position to finalize and implement that plan so that we're actually beginning runoff at a coming meeting, and that could come as soon as our next meeting in May. That's not a decision that we've made, but I would say that's how well our discussions went.
Hold on to taxpayers' money to keep this frothy market propped up.
A couple things just to add. We'll be mindful of the broader financial and economic context to when we make the decision on timing. And we always want to use our tools to support macroeconomic and financial stability. We want to avoid adding uncertainty to what's a highly uncertain situation already. So all of that will go into the thinking of the timing around this. In terms of I would say this. I don't want to get too much into the details because we're literally just finalizing them. But the framework is going to look very familiar to people who are familiar with the last time we did this. But it'll be faster than the last time, and of course, it's much sooner in a cycle than the last time. But it will look familiar to you, and I would also say that there'll be I'm sure there'll be a more detailed discussion of our in the minutes to our meeting that come out in 3 weeks, where I expect that it will lay out pretty much the parameters of what we're looking at, which I think will look quite familiar.
Thank you. Let's go to Michael McKee at Bloomberg TV.
Mr. Chairman, since September of 2020, you've been operating on a monetary policy framework that let the economy run hot to bring unemployment down. That seems to be over, but I'm wondering how you would describe your reaction function now. What is it that the Fed is trying to do other than bring inflation down? In other words, is it we're going to keep raising rates until it comes down to an acceptable level?
Yeah, so I want to clear one thing up again, and that is that nothing in our new framework or in the changes that we made has caused us to wait longer to raise interest rates. What we said in the framework changes was, and this was really a reflection of what had happened for the preceding couple of decades, actually. What we said was, if we see low unemployment, high employment, but we don't see inflation, then we're not going to raise rates till we actually see inflation. That's what we said. And that was the sense of it. There was no sense in which if we got a burst of really high inflation, we would wait to raise rates. That's simply not in the framework. In fact, quite the contrary. The framework is all about anchoring inflation expectations at 2%. So I do hear this, that the framework, we can't blame the framework. It was a sudden, unexpected burst of inflation. And then it was a reaction to it, and it was what it was. But it was not in any way caused by or related to the framework. So to today,
this guy's straight lying.
I think our vision on this on the committee is very, very clear.
Wow.
What we see is
reckless.
A strong labor market. We see a labor market
reckless
with a lot of momentum.
Death. I don't know how to describe it no other way, guys. This is reckless death by these people, and they refuse to accept reality, and they digging down further, dumbing down further in this level of ignorance.
Nonetheless, in the base case,
to push this narrative and this wealth gap theft lie.
But inflation is far above our target.
Well above, it's like 15%. Ignorant. That's a long way from 2%.
From supply side improvement, labor force participation,
these people,
bottlenecks, all those
things.
This
is why
better.
There's a need to shake up Washington. There's a need to overthrow this entire
to restore price stability,
facade of a system
to doing that,
and revamp it for something that's definitely new.
And you see that in the decision we make, and you will continue to see it in the decisions we make going forward.
If I could follow up by asking, I guess what you'd call it is the Paul Volcker question. You don't think unemployment is going to rise significantly, but if it does that temper your desire to keep raising rates?
Well, the goal, of course, is to restore price stability while also sustaining a strong labor market. We have a dual mandate, and they're sort of equal.
All right, I got a meeting to go to, guys, here shortly. So I'm going to wrap this up here shortly because
an essential goal.
You're going to hear the same narrative, right?
It's a precondition.
He's trying to tightrope walk his questions or his answers to appease, again, those who are sitting there waiting for him to dog whistle that they need to continue to just overinflate assets, which also cause inflation by keeping these companies at a point where they're not going to do the proper due diligence in terms of being able to really fix their supply chain issues as they should, which exacerbates inflation even more because the printing of the money caused this.
But we do understand
and then not only that,
you can't have
the balance sheet that's propping the market up at this point, even though QE has ended, it's going to be a very slow drip runoff in a way where they can just keep pressing the gas pedal and making it worse between Main Street and Wall Street. I'll sum it up when I come live again.
Thank you. Let's go to Brian Chung at Yahoo.
It's inevitable value that they're just kicking the can down the road,
tech issues here
as
on
we
this
said
front.
before.
Wanted to ask just kind of the broad question about how you are communicating what the Fed's doing here today to the average American who might not be reading the dot plots or understanding what the FCP is. How is the
read it over here.
hike today and then the signaling on future Fed policy going to address the inflation that they're feeling at the stores on a daily basis?
Sure. So I guess I'd start by just assuring everyone that we're fully committed to bringing inflation back down and also sustaining the economic expansion. We do understand that these higher prices, no matter what the source, have real effects on people's well-being. And really, inflation takes a toll on everyone, but really especially on people who use most of their income to buy essentials like food, housing, and transportation, where I mean, we've all seen charts that show if you're a middle-income person, you've got room to absorb some inflation. If you're at the lower end of the income spectrum, it's very hard because you're spending most of your money already on necessities, and the price is going up. So, but it's punishing for everyone. So it has been a difficult time for the economy, but we do anticipate that inflation will move back down, as I mentioned earlier.
This guy.
It may take longer than we like, but I'm confident that we'll use our tools to bring inflation down. And you asked about rates. So the way that works, I would explain, is as we raise interest rates, that should gradually slow down demand for the interest-sensitive parts of the economy. And so what we would see is demand slowing down, but just enough so that it's better matched with supply, and that will bring inflation down over time. That's our plan.
Thank you. Let's go to Jolene Kent at NBC News.
Hi, Chair Powell. Thank you so much for taking my question and doing this today. My question is a follow-up to what Brian just asked. What is your message to consumers out there who can no longer afford the basics due to this high inflation?
Well, that is, yes, indeed. I mean, as I just said, I think we do understand very much, and we very much take to heart that it's our obligation to restore price stability. And we've had price stability for a very long time, and maybe come to take it for granted. But now we see the pain. I'm old enough to remember what very high inflation was like, and we're strongly committed as a committee to not allowing this higher inflation to become entrenched, and to use our tools to bring inflation back down to more normal levels, which our target is 2% inflation. So we will do that. And I just would want people to understand that. But the way we do that is by raising interest rates and by shrinking our balance sheet. And so financial conditions will become, at the margin, less supportive of various kinds of economic activity. That will slow the economy while also allowing the labor market to remain very strong. And the good news is the economy and the labor market are quite strong. And that means the economy, we think, can handle interest rate increases.
And as a quick follow-up to that, obviously the Federal Reserve walking this very complicated fine line, trying to avoid a recession. For the consumers out there who are worried about their jobs and a possible recession, what do you say to that?
Well, I say that our intention is to bring inflation back down to 2% while still sustaining a strong labor market, and that the economy is very strong. You look at where forecasts are. People are forecasting growth that's strong within the context of U.S. potential economic output. And we expect that to continue. And to the extent the data come in different, then of course our policy will adapt. But we do believe that our policy is the appropriate one for this forecast, and we believe we can bring down inflation. We believe that we can do so while sustaining a strong labor market. The labor market it's not strong in the ordinary sense of the word. We have not seen a labor market where there were 1.7 job openings for every unemployed person, or where if you add job openings to those who are employed, that's actually substantially a larger number than the size of the workforce, than the number of people who actually count themselves as in the workforce. So this is a situation where demand is higher than supply, and when that happens, prices go up. So we need to use our tools to move supply and demand back, and we don't think we need to do this alone. There will be other factors helping that happen, but we certainly are prepared to use our tools, and we will.
Thank you.
Thank you. Let's go to Simon at The Economist.
Thank you, Michelle. Thank you, Chair Powell. Sorry to keep you away from inflation for 1 minute. May I ask about the sanctions on Russia and specifically the freezing of the central bank assets? Of course, that raises a similar risk for other sovereigns around the world and their biggest companies potentially. Any concerns about, in the long term, how this might affect the dollar's status as the preeminent global reserve currency? And in the past couple of weeks, have you had to deliver any kinds of reassurance to other central bankers around the world?
Well, so of course, central bankers around the world are generally very, very in favor of all of these sanctions. But let me say this: sanctions are really the business of the elected government, and that's true everywhere. So the administration, the Treasury Department in particular, and other agencies, they create these sanctions. We're there to provide technical expertise, but they're not. It's not our decisions, so I'm reluctant to comment on sanctions really much because again they're not for us. We have a very specific mandate, and these are really the province of.
All right, guys. Sorry about that, guys. I gotta go. I got an important meeting. I tried to go long as I could, but I got to make sure I handle this real quick here. I got a couple things coming up. A couple people got training sessions, and I got a meeting as well. So again, I just tried to come on and give you guys a little window into this catastrophe of a scenario that we're dealing with every day, with them particularly, kicking this can down the road, exacerbating the situation, protecting those who are just, sitting in the stock market. Again, people who, we benefited from it. Yes, we do. However, the one thing we cannot do and we will never do is lie to ourselves in terms of what we see, what we research, and how we interpret the data. So for a lot of people who are inebriated to this stuff, they don't understand how this stuff works. This is why it's important that you learn this at the level that you need to, so you can help bring people up to the level of literacy and understanding how markets work, how the government works when it comes to policy, how it works when it comes to financial situations and conditions that are less than favorable when them trying to put money together to kind of survive with, and exactly what's causing it. Why? Because you can speak to it, you can educate them to it, so they can be more comfortable knowing how this stuff works. So again, shout out to everybody who take that who take this information serious, who's trying to be the best they can at it. This is not gambling. This is not about trying to prove that the market's going to work for you and only you, and not necessarily follow the information, the research that's necessary for you to be good at this. You have to understand that this is a bigger insidious situation that's over you when it comes to how they're making these blank check statements, and they're taking blank checks away from the taxpayers, and they're just funneling money into every other place except into your life. It's to the point now it's not even funny that people just go along with this sham, this scam, literally every single day, because they have a loose understanding of how they allow people to just make a mockery of them, a lot of them, or push a propaganda reel to get you all emotional while they go in your back pocket. And it's not going to change. It's not going to stop. Why? Because people feel as if, again, I've never met a person complain about making money, right? Or I'm making too much money. They know the situations they may cause it. And I'm speaking to the people on our side. Why? Because they're never going to push the narrative for them for Jerome Powell, the administration, to say, hey, whoa. Okay, yeah, we know a lot of people who are maybe not in this industry as of who are really suffering right now. And we need to really slam the brakes on all this. Why? Because we benefited from literally quantitative easing since 2008, 2009. We haven't stopped. And maybe it's time for us to really do something for the American people. It's them against you. And it will always be that way. Why? Because they can care less about the average person. And I'm meaning you, meaning the average person, the Main Street person. And so that's why education in this is non-negotiable. Why? Because before y'all got into investing in trading, you was that person on the other end that's not understanding how this stuff works. All you knew is that you just saw the economy going up and down. You didn't really benefit from policy that you feel like was necessary. You heard them talk a good game when they let these officials or these presidents, and you really say, okay, where's the change? Where's the change? Am I really seeing the change? I don't really see a change. It becomes a point where it's like, okay, at some point you got to start figuring out what you need to do to realize why things are not working the way they're supposed to be. When they come on and tell you that they are, but they're not really working, you don't feel it. Well, this is why, because they have paid shields, they have protectionists, they have lobbyists, they have people who get in front of your vote, get in front of your voice, get in front of your ideology of what this system's supposed to do, and derail that into some other agenda that affects that corporation, to help that corporation, to help this NGO, to help this other nation, to help this other illegal immigrant, to help this scenario except you. So this is why we go hard to bring this information in a way where you need to understand it from the real perspective, no cap. Why? Because the government has made a lifelong agenda out of capping every day. And they know people who are, again, confused, who are just sleep under all these different ideologies, they're never going to challenge the system. Why? Because they don't, in their mind, they don't know how. So they go along to get along, and they pay, and they suffer, and they sit through it as if they're supposed to. But I'll leave it at that. So I'm out, guys. I got to go real quick. I'm already late, 20-some minutes late. I thank y'all for tuning in as always. Peace, power, and profit, everybody. Thank you, Oba Chris, as always. I appreciate you, man, 100%. Everybody that tunes in, you guys are awesome. Again, we got training tomorrow. We look forward to seeing you guys. Hopefully, we may get an Urban Economic Empowerment show in this evening. Sister Monica ain't too busy, but she's going through tax season. But anyway, thank you guys all for tuning in. We see you guys on the next one, guys. Peace, everybody.
All right, peace, power, and profit.
Peace, family. Peace, everybody. Peace.
Peace.